if you're an investor like me, you've got to find jurisdictions where they're compliant with the local regulator. Now, the most advanced in my mind right now is Canada. I think this is actually a maturation process for the crypto market. There's two basic baskets of crypto projects. One, highly speculative tokens, and you could say UST and Luna certainly fit that because they've been repriced dramatically. Highly unlikely in the context of stable coins will they ever return to their old prices, because people have figured out a stable coin should be stable. And that means it has to be backed by something of asset value. You can note that USDC did not correct that way during the period of this mass correction of other algorithmic or other quantitative or speculative stable coins that really got crushed. Circle, the company that issues USDC, was able to raise $200 million from Fidelity and $200 million from BlackRock. That's unprecedented in equity for the company. So that's signaling that that type of stable coin is favored by institutional investors versus the others, which look like they were retail products. So you've got all this speculative stuff. The NFTs have corrected. The Las Vegas side of crypto has had a nightmarish correction. And I think that's very good in the sense that it helps separate the wheat from the chaff, or the cream from the milk, if you wish, whatever analogy you want. Because the traditional projects have remained relatively stable. Sure, they've had a correction, but it's not uncommon each year for Bitcoin to give up 50% of its value, and that's certainly been the case here. Ethereum, same thing. And so that's the volatility that will be inherent in crypto until there's policy.
You know, there's talk that with some technical analysts calling that, hey, even more pains in store for Bitcoin, that it could possibly head down to 12,000. What do you make when you hear these numbers thrown around? Do you think that this crypto winter will be a long one, or any sentiment as to where the market will head now?
No one's been able to forecast its volatility. And, you know, the speculation that it was going to be a hedge against inflation was just flat out wrong. And that didn't work. And maybe it will work one day, but I'd argue that the volatility on Bitcoin is going to remain very akin to what Amazon was for its first 15 years, 30 to 50% corrections every 12 months, because there was no institutional support in the early days of Amazon. It was a retail product as people started to use the service, bought the stock. That's the same right now for Bitcoin. There is no, you know, people talk about institutions owning it. That's just not true. They don't own any of it, and they won't until the SEC rules on it. There is some institutional ownership in the Canadian market by Canadian institutions because they can use the ETF and equity mandates, but that's Canada. They were the first to allow an ETF with Bitcoin as the underlying. They also allowed an Ethereum ETF, and so those are positioned, but they're inside of equity mandates. The actual ownership of Bitcoin itself remains elusive to the institution because of their own compliance departments, and on top of that, no infrastructure for compliance. There's no way to market into any of these systems the price of Bitcoin, or whether it's levered or not during the day, the way you can with stocks that have been treated that way for decades. So there's so much work to be done. And this is a predictive correction in the market. We haven't actually had the bad news yet. We're just predicting it. So we're pulling down valuations, and really rapidly across all sectors. There's nowhere really to be safe right now, with the exception of energy, because energy prices continue to spike, and the cash flows of oil companies that have fallen out of favor, and even the president didn't like pipelines, et cetera. Well, that turned out to have been a mistake. And now we have these exceptionally high $4.50 to $6 gallon prices, and consumers are not happy. And so the question that everybody, including me, has every day when I see a correction like this, when I see Walmart down 20%, for example, which is a bellwether stock, if I'm an opportunist, I might put on a position. But what I'm doing right now is I'm waiting for the big event, as I call it. And you get these events, and we talked about it. That day will be an interesting day to put 130 positions on. It'll be a day of panic. We'll be down somewhere between 2,000 and 3,000 points. And yeah, it's horrible to talk about it, but that actually is very healthy, very, very healthy. You get the PE of the market down into the 15 range, even lower. That's a tremendous buying opportunity. And I actually think earnings are going to be pretty good into the first and second quarter next year, because we're still at full employment. All of these concerns and the Armageddon scenarios, and these are putting pressure and compressing PEs, but I haven't seen the downturn of the consumer yet. And so you need to kind of see that. Everybody's forecasting it, that's true, and pricing it into the stocks of consumer products and retailers like Walmart and Target, but they actually haven't seen it yet.
It is a new asset class, and it is the leader of the new asset class. And so I don't think it will be going up immediately because of a breakdown in our economic prospects. And I also think that all of the technology, I'm going to take the other side of this bet, I think the technology revolution, and it's not just blockchain technology, it's genomic sequencing, robotics, energy storage, artificial intelligence, all of them are highly deflationary, and all of them will be very destructive to the traditional world order, but they will present massive opportunities for growth. So I feel as though it's going to feel chaotic like it does now. I do believe that we're heading into a deflationary world, and it will be very good for some companies. They will boom. You lower prices, you get more demand. But other legacy industries are going to be sitting there with stranded assets, and there's going to be a lot of confusion about what's going on, as there is today. So we shall see. 14 million out of the 19 million Bitcoin out there have not traded in more than 6 months. We've got a lot more hodlers out there, I think, than people appreciate. Yeah. One of the reasons. And, you know, I've said this before, but I think it's so important. You know, Bitcoin, yes, the populist movement, but it is also a new monetary system. It is the first global, big idea, private, meaning not oversight by a government, digital, rules-based monetary system. I think it's a profound idea, and more people around the world are beginning to appreciate it as they're seeing their currencies fall apart with the dollar strong. This hits emerging markets usually hardest.
Yeah.
The largest component of that is we do believe that Bitcoin will usurp 50% of gold's role. This is digital gold. So that's roughly a $5 trillion opportunity right there. The smallest one is remittances. We think that it will take most of the remittance market. The remittance market is a $600 billion market. We have insurance policies, high net worth individuals watching, you know, confiscation of wealth.
Right.
And with all the turmoil in emerging markets and elsewhere, who knew that MBS was going to take his cousin's wealth away? So don't they wish they had some Bitcoin and private keys? Also companies allocating some of their cash or diversifying some of their cash into Bitcoin. We've seen Tesla do that, Coinbase, Square, of course, MicroStrategy, and you're going to see some countries putting Bitcoin into their treasury. Right. We assume only 1%. So if you look at the building blocks and then finally institutional, how much will institutional investors account for this? Well, we assume that institutional investors will put 2.5% of their allocation to Bitcoin. So I think there's a bifurcation going on, which is good. Services are 2/3 of consumption, so it means we won't have a serious recession, but goods inventories building up, I think, is going to cause pricing to come down. If you look at goods spending on non-durable and durable goods, it's falling apart, and inventories are rising rapidly.